Okay, let's just jump right in. Imagine starting the new year, not with, the usual resolutions, but with the actual knowledge that your income portfolio is really humming.
Right. Delivering consistently high cash flow right into your pocket.
Exactly. And for an income investor, that idea of a happy new year really just means maximizing your yield without falling into those classic traps of ultra high risk.
And that's precisely the mission for our deep dive today. We've been looking at sources that have singled out 5 specific ultra-high yield dividend stocks.
Okay.
All of them have yields way above the market average. But the idea here is that they might offer that rare mix of a high payout and, real long-term consistency, potentially through 2026 and even beyond.
And what immediately jumps out at me is just how different they all are, the structural diversity.
Yeah.
I mean, we're not just looking at 5 banks or 5 tech companies. This list crosses 3 totally different sectors and business models. We have a business development company.
BDC, yeah.
We have a few midstream energy limited partnerships. And then we finish up with this massive real estate investment trust.
It's almost a perfect example of how you can build reliable income by tapping into, well, distinct economic engines. Each structure is basically engineered, either by tax law or its business model, to generate and push huge amounts of cash directly to shareholders.
So understanding the why behind that consistency is the real goal here.
Exactly, understanding the engine.
All right, let's get into it. The king of high yield on this list has to be Ayers Capital. The ticker is ARCC. This is where you find that really lofty payout, right? It's currently got a forward dividend yield of around, 9.6%?
It does, yeah. And what's so interesting here is understanding the BDC model itself. ARCC is the largest publicly traded business development company out there.
And a BDC is. I mean, you should think of it as a specialized kind of finance company, right? It's like
Right.
a private lender to middle market businesses.
That's the perfect way to put it. These are companies that are often, too small to tap the public debt markets, but they're way too big for a simple bank loan. ARCC steps into that gap.
Okay, but when we see a 9.6% yield, I think our first instinct is to immediately look for where the ultra high risk is. I mean, ARCC is lending to companies that probably don't have investment grade ratings.
Right?
Is the sheer scale of their operation really enough to offset that fundamental risk in private credit?
That is the critical question you have to ask. And the short answer is yes, because the risk mitigation is built into their structure.
How so?
Well, first, as you said, scale. ARCC is huge. It manages I think it's a $28.7 billion portfolio, and it's diversified across more than 15 different industries.
So one default doesn't sink the ship.
Not even close. It's a tiny fraction of the whole. And second, and this is key, most of ARCC's investments are in senior secured loans. That means if a borrower goes under, ARCC is first in line to claim the assets.
So they're prioritizing capital security over just chasing risky returns.
Absolutely. But let's get to the why of that high yield. It's the tax structure. BDCs are set up to avoid corporate income tax, but only if they distribute at least 90% of their taxable income to shareholders.
It's not optional for them, it's mandated.
It is mandated. That forced distribution is the reason the yield is structurally so high.
That makes a lot of sense. And there's something else in the sources about the current economic climate giving them a bit of an edge.
Yes, the interest rate component. The vast majority of their debt portfolio has floating interest rates. So, as the Fed raised rates over the past couple of years, ARCC's income from their loans went up almost instantly.
Which helps them easily cover that big dividend.
Comfortably. And it helps sustain their payout streak, which, by the way, is now 16 consecutive years of either maintaining or actually growing the dividend. That's a powerful mix.
A near 10% yield, backed by scale and structural consistency. That's a strong start. Okay, so that structural consistency is the key takeaway. Now let's pivot completely. We're moving from the, lending engines of corporate America to the physical engines, the actual infrastructure that keeps the lights on.
The pipes and wires. Midstream energy.
And if we're connecting this back to the big picture for income, midstream is all about minimizing your exposure to commodity prices, right?
100%. These aren't drillers selling oil at whatever the volatile market price is that day. They own the pipelines, the terminals, the storage facilities. They are basically essential toll roads for energy.
And our second pick is a giant in that space, Enbridge, ticker ENB. The sheer scope of what this company does is, it's pretty staggering when you look at the numbers.
It really is. It's an essential service. I mean, think about this. Enbridge transports 30% of all the crude oil produced in North America.
30%.
And 20% of the natural gas that's consumed in the U.S. And they're not just pipelines, they're also North America's largest natural gas utility by volume. They serve over 7 million customers in the U.S.
So that utility business adds another layer of regulated, predictable cash flow.
Another layer of safety, exactly.
So how does that stability translate into, reliable cash for an income investor?
It all comes down to the contracts. Unlike the drillers, midstream companies lock in their revenue with these long-term fixed-fee contracts.
Right.
A lot of these even have inflation escalators built in and something called minimum volume commitments, or MVCs.
Meaning their customers have to pay for a certain amount of pipeline space whether they use it or not.
Exactly. They have to pay for that guaranteed minimum. So that whole mechanism just buffers Enbridge from any of those wild short-term price swings in oil and gas.
And that explains the incredible track record. ENB has a strong forward dividend yield of 5.9%, and it has raised its dividend for 30 consecutive years.
30 years.
A streak like that doesn't happen by accident. It has to be built on those predictable contracts.
And the sources we saw pointed out that this cash flow engine isn't slowing down. Enbridge has identified something like $50 billion in growth opportunities just through the end of this decade.
So they're already mapping out the next decade of dividend increases.
It certainly looks that way.
Okay, speaking of energy infrastructure, we have two more midstream leaders on the list, but they have a slightly different wrinkle, a different structure. Let's look at Energy Transfer, ticker ET, and Enterprise Products Partners, EPD.
Right, so both ET and EPD are structured as limited partnerships, or LPs. This means their payouts are technically called distributions, not dividends.
Got it.
And Energy Transfer is just enormous. It operates over 144,000 miles of pipeline. It's diversified across liquids, natural gas, terminals, everything.
And ET is offering a very attractive forward distribution yield of 8.1%. So we get the pipeline stability. But what's driving their future growth? What's the next chapter beyond the established toll roads?
Well, this is where it gets really interesting. It's where old energy meets new tech. The research shows that Energy Transfer has these really strong growth prospects tied to the huge boom in data center construction.
Data centers.
Yeah. These new facilities need massive amounts of stable, reliable power. And that power is very often supplied by natural gas generation facilities.
So Energy Transfer is signing contracts to supply the energy that feeds the cloud.
Precisely. They've already secured major contracts with companies like Cloudburst and Oracle. It positions them as a critical supplier to the entire digital economy.
That's a pretty compelling growth story. It adds a whole new vector to their traditional pipeline revenue.
A very significant one.
All right, now moving to Enterprise Products Partners, EPD.
Yeah.
This material kind of describes it as structurally similar to Energy Transfer. Same high-quality midstream LP model.
Yeah, you could say it's the same song, different verse. EPD is a giant in its own right. Operates over 50,000 miles of pipelines, plus huge storage facilities, natural gas processing, and really critical deep water docks for exports.
And they offer a distribution yield of 6.8%.
A very attractive one.
They don't quite have Enbridge's 30-year streak, but EPD is right there with 27 consecutive years of distribution increases.
Nearly 3 decades. That's some serious consistency. Their story is really one of financial prudence. The sources kept emphasizing EPD's extremely strong balance sheet.
Okay.
Their history of generating cash flow that is way more than what's needed to fund their distributions. The company actually has the highest credit rating in the entire midstream industry.
Which translates directly to payout reliability.
Directly. Investors know they can get capital when they need it and that they aren't, stretched thin just to cover that payout.
Okay, before we move on, we have to talk about the elephant in the room for ET and EPD. The LP structure, the yields are great, but what's the big caveat for an income investor?
That's a critical point. It's about tax complexity. While the distribution is high and often tax-deferred at first, these limited partnerships issue a Schedule K-1 for tax reporting.
Not the standard 1099 form you get from a regular corporation like ARCC or Enbridge.
Exactly. And for a lot of income investors, especially if you value simplicity, the K-1 can be a real headache. It often delays your tax filing and adds a lot of complexity.
It's the trade-off, right? For that high yield, you're trading financial simplicity for tax complexity.
That's the deal. You have to be aware that your accountant is definitely going to earn their fee on those K-1s. It's a balance you have to weigh for yourself.
All right. That wraps up our look at the BDC and the three energy giants. For our final pick, we are pivoting again, moving to the physical world of commercial real estate and the real estate investment trust structure. the REIT,
And we were talking about Realty Income, ticker symbol O.
the monthly dividend company.
That's the one. With Realty Income, it's this combination of just massive scale and an incredibly stable revenue stream. They own a gigantic portfolio, 15,542 commercial properties across 9 countries.
And their branding is the real estate partner to the world's leading companies. They're leasing to giants, right? Dollar General, FedEx, Home Depot, Walmart.
Yeah, very diversified tenant base. Over 1,600 clients in 92 different industries. And what makes their model so reliable for income is how their leases are structured.
The triple net lease.
The triple net lease, or NNN. This is the financial bedrock of their consistency. Under a triple net lease, the tenant, so Walmart, for example, is responsible for property taxes, insurance, and maintenance costs. The 3 nets.
So the tenant is handling most of the building's operational costs.
Correct. Which leaves Realty Income with this remarkably clean, predictable stream of rental income that isn't really burdened by, a sudden jump in repair costs or property taxes.
And just like DDCs, REITs are also required to distribute most of their income.
At least 90% of their taxable income to maintain their tax status, so that clean cash flow plus the distribution requirement is what fuels their current dividend yield of 5.7%.
Now, 5.7% might be lower than RC's 9%, but the consistency record here is it's almost unrivaled. They match Enbridge with 30 straight years of dividend increases, but they have an even more impressive claim to fame.
The quarterly number.
112 straight quarters of increased dividend payouts. That's nearly 3 decades without a single quarterly stumble.
It really just hammers home that point about reliability and slow, steady, incremental growth. Their whole business model is built for gradual, relentless compounding. But the detail that makes Realty Income ideal for an income investor is both structural and, you could argue, psychological.
The monthly payout. They're one of the only giants that pays investors every single month, not the typical quarterly schedule like the other 4 we've discussed.
Exactly. For anyone who is actually relying on these returns for living expenses, for retirement cash flow, getting income every 4 weeks aligns perfectly with a typical household budget.
Mortgage payments, utility bills, groceries.
All of it. It completely changes the personal cash flow game compared to waiting 90 days between payments.
So if we pull this all together, we've covered 5 companies: the Ors Capital, Enbridge, Energy Transfer, EPD, and Realty Income. The thread that unites them isn't just the high yield itself, but the verifiable track record. 16, 27, 30 years. Even 112 straight quarters of increases.
So what, for you, the listener, is realizing you've basically been shown 3 distinct, highly optimized income-generating machines. You've got the BDC model, which mandates high payouts from corporate lending.
Right.
You've got the LP model in midstream energy, which guarantees stable payments through long-term fixed-fee contracts on essential infrastructure.
And the REIT?
And finally, the REIT model, built on the stability of physical real estate, triple net leases, and the cash flow needs of the world's biggest retailers.
Each model is specifically designed to pull reliable cash flow from a core economic activity and just funnel it directly to you, the investor.
It's a portfolio built for structural income, not for speculation.
And that leads us to our final thought for you to think about as you plan your own financial Happy New Year. We've highlighted Realty Income's incredible track record, but we keep coming back to its unique monthly payout. So knowing that consistent cash flow is the ultimate goal, here's the question. How does that monthly payout schedule from a stock like Realty Income fundamentally change the psychological and financial experience for an income investor compared to the 4 quarterly payers we also discussed today, especially when you're trying to plan for retirement?